How do some real estate investors raise millions of dollars in private money while others can't raise a single dollar? Is it strategy? Is it credibility? Or is it something way deeper than spreadsheets and pitch decks? Welcome back to Raising Private Money. I'm Jay Conner, the Private Money Authority. Today's guest has been behind the scenes of over $1 billion in real estate education sales, worked shoulder to shoulder with names like Tony Robbins and Dean Graziosi, and personally invested in hundreds of real estate transactions, from wholesaling and rehabs to build to rent and commercial development. But here's what makes this episode different. At some point, my guest, Dave Lundgren, stopped chasing deals and started mastering trust and alignment and the inner game that actually attracts capital. Since shifting into syndications and passive investments, Dave has partnered with hundreds of investors, raised over $20 million in private capital, and helped people create real financial independence without the hype, pressure, or shortcuts. Today, we're pulling back the curtain on how real authority is built, how private money really flows, and why mindset alone is not enough. Now, if you want more capital, better partners, long-term credibility, this episode is for you. You're going to meet my special guest, Dave Lundgren, right after this.
If you're a real estate investor and are wondering how to raise and leverage private money to make more profit on every deal, then you're in the right place. On Raising Private Money, we'll speak with new and seasoned investors to dissect their deals and extract the best tips and strategies to help you get the money, because the money comes first. Now here's your host, Jay Conner.
Welcome to the show, Dave. Glad to have you.
Thanks, brother. Good to see you, Jay.
Good to see you too. Now, before we dive into all this stuff about syndications and the bond equity alternatives and private money, I want us to make a distinction for our audience between what is private money, doing individuals with individuals with no brokers involved, all asset-backed debt, syndications, and then the bond equity alternative, which is going to be a new strategy. Can you break that down for us? What's those differences and nuances?
Yeah, great question. Start it all off. So the quick answer, you're an expert in private capital and private lending. You teach your folks that, and that typically is a relationship, like an individual relationship, right? It's maybe you're out golfing with your buddies and there's a doctor and there's an attorney and, a couple guys hanging out and you're like, hey, I got this real estate deal over here. You got some money in your 401k, let me take that $100,000 and get you a good return. That's a very simplistic view of private capital or private lending a lot of times. Syndications typically means we're talking about, we're creating an actual agreement, a legal agreement, and typically, this is an overgeneralization, but typically it's several people pulled together in like a limited partnership with the general partners. And so the general partners typically will sponsor, have the deal put together, and then they'll raise capital from several limited partners and typically give them some kind of preferential and then maybe an equity kicker. So the quick answer is it's more of a institutional. There's an agreement, there's legal agreements, and typically it's more than just a handful of folks, or it's more than just a one-on-one type of relationship. That's a very quick, broad explanation of it.
Right. I couldn't have explained it better myself. Now, Dave, a lot of investors think that syndications, so again, on syndications, you're raising a lot more money for larger projects, commercial, multifamily, et cetera. A lot of investors think syndications are the quote unquote end game for raising capital. And why would you believe that assumption is broken for a lot of deals?
Yeah, another great question. I think it's so individualized, right? I would hate to take a broad stroke and say, hey, this is the right type of thing for everybody. It could be a one-off. There's amazing deals that you've done with a lot of your folks and teaching people just a private lending situation. And that may be the right situation, right? So somebody who's maybe 75, retired, is in a different spot than maybe a 35-year-old couple and looking to be more aggressive. So I would never do a broad stroke. Hey, this is the right type of investment for anybody. And even inside the syndication, there's different assets. There's self-storage, there's development stuff. there's also, and even outside of real estate, there's things you can invest into. So I would never tell anybody, hey, everybody should be investing in one type of real estate, or even real estate, just real estate. I think it's really dependent on your facts and circumstances in your individual situation, where you're at in the retirement cycle, whether you're, W-2 aged, whether you're 35, whether you're 75. So that's where having a personal relationship with somebody and really get into their facts and circumstances can help you, help them decide what's the best type of investment for them.
Well, what you just said is so true, because it reminds me when I'm talking with a new potential private lender, I'm not looking to ask for money. I'm not looking to get money out of that initial conversation. I'm simply looking to diagnose, do they have a problem that maybe I could help them with, i.e. not getting high rates of return safely and securely. Once I diagnose that they have an interest in that, then one of my next questions, which ties into what you just said, is, well, when it comes to investing, what are your objectives? What's important to you?
Yep. 100%. Couldn't agree more. And knowing you in your heart, right? And one of the core things that you teach, especially in the private lending world, it's a relationship, right? And at the end of the day, if I genuinely am having a conversation with somebody and I know I can't serve them, it's like, oh, we don't have a mutual basis doing business. I wish you well. Go invest in whatever you need to. I don't have anything that fits your particular parameters. And coming from that servant leadership and coming from that looking to add value, people feel that, especially in the private lending world and certainly in syndications, because there's so many opportunities out there. And, the numbers are going to be the numbers, and the math makes a lot of sense and a lot of different opportunities. But as you know, a lot of people are making that decision based on not just the race, but the jockey. Who's the jockey on that horse? And that makes a big difference.
Yes. Now you've got a strategy of attracting capital that I don't think many people have heard of. And you call it a bond equity alternative. So I want us to dive into that. So you've developed a bond equity alternative that can, depending on the deal, outform traditional syndications. So what problem does the bond equity alternative solve that most investors maybe don't even realize they're facing?
Yeah, excellent question. And to be clear, I didn't develop it. It came to me. So 3 partners and I have 75 acres here in Kansas City, Missouri, just outside of Kansas City, a larger development deal. And we're looking to raise capital, which is typical for syndication. So we're raising some capital. And I came across a broker who brought, and private credit and bonds have been out there, like literally Wall Street bond, right? And so she brought to us this bond financing opportunity. And let's say this happened to be about $100 million project, but it's got to be something that's 50 million or more. So it's not a fit for everything. But she basically said, hey, once this bond company underwrites your project, they will finance 100% of it. So you don't have to go raise capital from a bunch of investors, and you get to keep the majority of the equity, 85% of the equity, versus typically on a syndication. Let's say it's a $50 million project. Typically, I'm going to have to go raise 10 to 15 million in capital. And those limited partners are typically going to get the majority of the equity. Typically, it's like 60, 40%, something in that range. So she presented this bond thing. We're like, oh my goodness, we get to keep the majority of the equity, and we're going to one source to raise the capital. Well, the caveat was, she's like, here's the bad news. It's significant due diligence. Typically, it's about $1 million, $1.5 million in due diligence, because they're basically underwriting this like a Wall Street IPO or a stock. And that typically, is going to take you 90, 120 days. And 20% of the time, the due diligence doesn't work out and you're out to your $1 million, $1.5 million. Right? Partners and I are like, well, we're not willing to risk $1 million. Well, she came back to us a few months later and said, hey, I've got an equity company that's done enough deals with this bond company that they are willing to pay that due diligence up front. They want 1% equity on the entire project, and they want 15% on their money. Now they'll defer that. So long story short, she came up with a solution. Now we're literally on a $50 million project or bigger. It's not for every deal, but for the right deal, literally you don't have to raise capital. It's a no money out of pocket situation, and we get to keep the majority of the equity. So it completely takes the syndication model and flips it on its head. That's the very quick explanation of it.
Okay. You may have touched on this in your explanation, but for investors, I'm not talking about private lenders, but for us,
Yeah.
listening to you describe this, who are maybe tired of complicated PPMs, investor management, compliance, headaches. Does this alternative answer any of those situations, or in any way simplify the capital stack?
Yeah, great question. The quick answer is yes, it simplifies the capital stack because it's one source of capital. Now, the caveat, all those same requirements, like if I'm going to create a PPM and I'm going to do a regular syndication, all the necessary documents, including it's got to be a great deal, all of that has to be in place as well. So it doesn't change that piece of it, but it does change the capital stack because it's literally one source of capital. It's a Wall Street bond company that underwrites and pays for the entire project.
Well, and it would simplify it because you're not, as far as the capital goes, you're not having to communicate with more than one entity.
Correct. Yeah, which does help because, as you know, at least in my experience, you're talking to dozens of folks raising capital and syndications, and it's a lot of moving parts and pieces. So yes, and again, it's not for every deal. I mean, this bond company, they're looking for a great deal. They're not going to take every deal that comes down the pipe. So there's some caveats, including, the project has to be shovel ready, and it's only a 5-year deal. Like that's the max they would do. They don't want to be in the deal for more than 5 years. So there's some caveats to it. But for the right type of deal, for anybody raising capital and doing larger syndications, it really can be a game changer.
Awesome. So you mentioned, this type of funding, the bond equity alternative, is not for every deal. So what types of real estate deals or projects does this bond equity structure work for best? And just as important, when should an investor not use it?
Yeah, another great question. The deals that are they're already in the pipeline right now are development deals. So most of what I've done is new construction, residential or small commercial. So that fits if the land's entitled, if you're shovel ready, because they don't want to wait, 2 years on entitlements or taking the land from ag zoning to that. So that fits. Existing larger deals could be an apartment complex that's getting revamped. These guys are actually do international too. So it doesn't have to be real estate. It could be, this isn't an underwriting yet, but this is a deal they're looking at. It's a mining operation. They're looking at that. So they're open to alternatives, not just real estate investing. And it can be international, but the core of it, at least the things I'm breaking to them, are real estate, just because that's the world I've been in. Those are relationships I have. So development could be completely revamping a large commercial. I mean, certainly they're interested in storage, RV parks, any type of commercial real estate. The floor is 50 million. So that is one caveat. At a minimum, they want 50 million or more on the project. Other than that, they're pretty open to looking at just about anything.
Gotcha. And I know you're in the midst right now of doing some capital raising. What kind of projects do you have going on right now?
Most of them are real estate development. There's this mining operation that came to me, a good friend, kind of a spiritual brother, and it's the only reason I looked at it. He's got some claims on some pretty amazing land, so that's brand new to me. I'm bringing some advisors in to help me with that. And then one thing that's pretty exciting that's somewhat related to all this, because I've been in the new construction world, is steel framing. We're taking steel framing, which is used a lot in commercial, but only 1% of the time in residential. It's actually 30% cheaper, 40% stronger. It reduces insurance 40%, and we can frame up a house in one day. And so it saves you literally on a build project 10% across the entire thing. And so where affordable housing is a real issue, some partners and we're taking steel framing to the market. So there's a couple different opportunities on that, including you could be part of the manufacturing plant with us, and then certainly taking steel framing to the residential market, which, like in Australia, they use 50% of the time. In the US, it just hasn't happened yet, but it's something we're going to be taking to market. So that's exciting to me because that's a project that can make great returns for folks, but it also feeds into all the builders because we're saving them a lot of money on their build, and we're saving, if they're a build to rent and they're holding, 40% reduction in insurance is massive. So we're hitting the affordable housing from different angles, which is a big problem. So that's exciting to me.
Yeah. And that's another thing that you have done, Dave. You've helped builders dramatically increase, sometimes even double their profits. In addition to the steel framing for residential, what are some other ways that you've helped builders raise their profits? And then secondly, what are some mistakes that builders are making that's like destroying their ROI?
Yeah. So the biggest way we've helped them is double their profits is through the steel framing. So across the board, talked to dozens of builders in the last couple of years, things have tightened up. Insurance rates are up. There's still a massive need for housing, but the margins have got tighter. So builders are making somewhere between 5, 7, 10, sometimes 12%, right on the project. Well, we're going in and you take all these factors on the steel framing, from reduction of the product cost to reducing, 1 day instead of 6 to 12 weeks, reduction of insurance, all the, you don't have any dumpsters. There's no waste because we're literally doing a rector set. So you factor all those things in together, and instead of making 10% on let's say in Kansas City, where I live, a $450,000 entry level new build, if instead of making $45,000 on that, if they can make $90,000 on that, that's the biggest way we're really helping builders double their profit, just through that one product and the infrastructure, the relationship to steel framing. I would say the biggest mistake I've seen, and I've personally been a part of deals that didn't go well in the last couple months, really is just not being due diligence in your underwriting, right? It's just like expecting the market to always be going up, not being conservative enough, I think, in your underwriting. I'm lucky enough, I'm in Kansas City, which is a great market. That's kind of the steady Eddie market. But there's been some other markets that have softened up, like Florida, for example. And I know some builders have got in trouble there as they were expecting. And sometimes in syndications, they've relied on that cheap debt that we had 3 or 5 years ago. And they are on the road at expecting, no, I'm always going to have 3.5% or 5% interest rates. And when that changed, and if the market softens up at all, it's all of a sudden, oh, you're 15% margin. Now you're down to 5%. And every additional, month of holding costs really eats into profit. So those are very simplistic, kind of high level, just what I've witnessed, experienced, and seen myself.
I don't know if builders, and I've done building projects. I've built condominium developments from the ground up, shopping center from the ground up. But as far as number of transactions, it's been a lot more in the single family area.
Yeah.
But I don't know how important the mindset is, or a mindset shift is, for builders or developers who believe that their margins are just the cost of doing business. Is there any kind of mindset shift or structural change that immediately alters the math in their favor? I mean, do they need to think differently about the way they're approaching business, or do they just need to have their eyes opened?
Yeah, that's a great question. Probably a combination of both. And again, I've been in this game for about 25 years. I started in the educational side, started selling turnkey, and then realized, oh, we can develop. And all that being said, what I saw back in about 2015, 2016, when Than Merrill from Fortune Builders taught me syndications, I watched him get on a webinar and raise capital for the syndication we put together in Kansas City. I was like, oh my goodness, he just raised all that capital and we just did a development deal. And that was it felt just as easy as selling one turnkey. But what I saw, and my bias was, when you're taking somebody else's money, that's very different. Like, I've got risk capital and I'll risk my own money. But when you're taking somebody else's, to me, I wanted to see, okay, there's got to be several different exits. And I watched 2008 happen, right? But what I witnessed in 2008 was, in a market like Kansas City, in a good neighborhood, if you're building a new construction house, I've got 3 exits. So if I build it and I'm at least in that, 80, 85% LTV, and I've got a little bit of margin, even if the market tanks and the retail price goes down and depresses a little bit, I'm okay because I can put a renter in there. So if the market's up, I got retail. I can sell that thing retail. If the market goes down, I just hold it, or I can sell it to my turnkey sellers. And a local bank, even when the market's depressed, local banks will refi you out and you can just hold it. So to me, having 3 exits got me excited about that asset class because I watched 2008 happen, and I watched builders that held on to their inventory and they just waited for the market to recover. Versus like in Kansas City, if I'm doing $1 million high-end flip, to me, there's a little more risk and reward. So to me, a developer or builder, my mentality is more of that steady Eddie conservative approach. And no matter what the market does, I don't think another 2008 is going to happen anytime soon. But if it did, could I pivot? And do I have more than just one exit versus, oh, I'm doing a high-end retail flip, or if I'm doing high-end houses as a developer, custom houses, to me, there's more risk and reward there. So I've always gone towards that bread and butter, entry level, new construction, good school districts, and just make sure, my margins are high because things are going to shift. Things are going to go up and down. Debt may change, your capital stack may change, but as long as you got enough margin and you've got at least 2 or 3 exits, you should be okay.
Well, I tell you, I know from experience, having only one exit strategy is a dangerous place to be.
Yeah, for sure.
Because you got to be able to be flexible and pivot with the market. Dave, I want to pull back the curtain on why it is you do this and why you're doing what you do. In other words, what's your passion and your mission behind this work? I know you got a spiritual foundation. You're not in this totally 100% for the money. There's more of a foundational reason than that.
Yeah.
And why are you so committed to helping people make money passively through real estate investing? And the bottom line question is why are you doing what you're doing?
Yeah, excellent question. Yeah, I do have a background. In previous life, I was a chaplain in the Army before I came into this real estate investing world. And I'm very, and I run a men's retreat. I do a lot of work specifically with men and their spiritual work, because that just my own journey. I can speak to those men, and I've been through my dark night of the ego. And so I have a lot of passion for that. Outside of working just with men spiritually, I'm very bought into sovereignty, right? Meaning if I can wake somebody up spiritually and financially and pour better finances into somebody who's aligned, now we're talking about something that has real power. Because, some people get caught up in money or time or energy. The reality is money is just like anything else. It's like time, right? And some people have a hang up about getting more money. But if I can help somebody in their spiritual or emotional walk, and I can add fuel to the fire by getting them more resources, well, good. Now I can create significant impact because there's a leader there who can then have the resources to go accomplish mission, church, charity, whatever they want to do. Money is just one more leverage point. And so I'm very passionate about real estate. This is my bias. I'm not a stock guy. I'm not in commodities, not to knock on any of those. But my simple mind just went to, I just watched what most millionaires are doing. And I could measure, okay, I'm getting 4 returns. If I buy and hold a piece of real estate and I do it right, the right market, the right team, those are the caveats. I'm getting 4 different returns. I'm getting cash flow, I'm getting appreciation, I'm getting these tax benefits versus, again, go back to 2008. A lot of people I talked to who had just lost half of their retirement in the stock market, and they had so little control over that. They're relying on some other company and some CEO of a company they've never been a part of. And I just watched that. I'm like, okay, real estate for me became a passion just because I saw the control you could have. You measure 3 times, cut once in real estate. But once you do that, even if a 2008 happens again, ride it out. You can get the cash flow and wait for that to come back. Because historically, since we're on our money supply is always going to be creating more and more debt because we're on a currency. It's not even real money anymore. That asset is always going to go up. So I'm very passionate about people that want to create long-term wealth and buy back their time and create freedom for their families and flexibility. I've just witnessed it with real estate. And again, that's not to knock on any other asset class. Just when you look at a good piece of real estate, and even I use a lot of Warren Buffett quotes to sell real estate because he talks about cash flowing assets. And he'll get a stock that has a dividend, and that's 2 returns, or farmland that has cash flow. But his caveat is like, you have to be able to manage them. And that's an important part of real estate, right? So that's why he shies away from holding real estate. But if you can solve for that and get a good team on the ground, dollar for dollar across the board, when you're getting 4 returns for $1, real estate, when you do it right, is just going to outperform any other asset class, in my opinion, in my experience. So I get passionate about that, so people can have freedom, so people can have flexibility. I don't think we're here to be slaves to the grindstone. I think we're created as sovereign beings, and we're here to enjoy it.
I love it, Dave. I love your heart. What advice would you give to a real estate investor that has never raised capital before? What do they need to get straight first in their mind?
Yeah, well, you touched on it. When you're talking to anybody, hey, what is their situation? How can I serve them? This person's got $50,000 and a 35-year-old couple. Cool. That's a different conversation than, a couple's got $1 million and it's all in self-directed and they're 75 and they're living off of this. That's a very different type of conversation. So watching your podcast and learning from people like you about the different types of people out there, and then the different opportunities. But that's it. Coming from a servant leader heart, how can I best serve these people? I'm not trying to squeeze them into everybody should be investing in this, I think is important. And there's so much education out there, podcasts, learning the different asset classes, and then getting your feet wet. I mean, going out and, I learned that. I went from being on the infomercials with Dean Graziosi and stuff to actually doing real estate. I did 200 flips in 1 year. And I went from doing a handful of rentals to that. I learned a lot more about swinging a hammer and doing a rehab and doing deals. So that's the other piece of it. Have a mentor, have guidance from somebody like you who's been there and done that, right? To use an army analogy, if I've walked through the landmines and I can look behind me and say, hey, watch out for those grenades or watch out for those landmines, don't step on them. Get the right mentor, get yourself educated. And then, I'm a person of faith. I would definitely say, do the numbers, think about it, and then take a moment. And if you pray, go pray about it, and then trust your gut. Call out the spirit, call your gut, whatever that is. Your spidey senses are typically right. And then, again, the jockey, make sure you're making that decision based on that person and their track record. Because ultimately, if a deal has a little bit of wonkiness to it, you're going to rely on that person to figure it out and make things right.
Beautiful. Thank you, Dave. Dave, for the benefit of our audience, what different types of people that might be listening to the audience could contact you, and how could you serve them when they contact you?
Yeah, anybody who is looking to invest passively. If the steel framing thing's exciting, there's different ways of participating in that. You could own a facility. Certainly passive real estate, whether they want to be a part of a syndication or buying turnkey. And again, that's a different person. Typically a private lender is a short-term situation, kind of a one-off, which is your wheelhouse. So maybe anybody who's a little bit outside of that, that's looking for a different type, like a syndication, and certainly a developer. If there's somebody out there who has these large developments and that bond thing makes sense to them, or they know somebody like that, I'm happy to pay a referral fee on that. So anybody that fits that, I'd love to have a conversation with them. They can reach out. I think you're going to put my website on there. Reach out to me directly, and I'd be happy to have a conversation with anyone that's listening to this.
Yes, Dave's website is www.dave-lundgren, spelled LUNDGREN.com. And of course, that URL will be in the show notes as well. Again, that's Dave, DAVE-Lundgren, LUNDGREN.com. Reach out to Dave, have a conversation. You're looking to get some high rates of return than you have been getting. Dave is the guy to talk to. And if you're a builder developer, you're interested in learning more about the bond equity alternative, Dave can tell you all about that. Yeah. Dave, thank you so much for joining me here on Raising Private Money. And I look forward to seeing you in person at one of our upcoming mastermind meetings.
Thanks, brother. We'll see you soon. God bless.
See you soon.
Yep.
Listen, if this episode challenged how you think about raising capital or structuring deals or creating passive income, do yourself a favor. Don't let this be a one-off episode. On Raising Private Money, we don't just talk theory. We break down what actually works in the real world, how to attract capital, keep more upside, and build long-term credibility with private lenders. So hit the follow or the subscribe right now, because every episode, like, share, subscribe, click that bell if you're watching YouTube. Every episode here on Raising Private Money is designed to help you fund more deals without relying on banks or giving away control. And so if you found value today, leaving a quick review is more than a thank you. It helps other serious investors find this show and start funding their deals faster. Share this episode with someone who is stuck raising private money the hard way. I'm Jay Conner, the Private Money Authority. And remember, when you master private money, you don't wait for opportunities, you create them. And as a final bonus, let me invite you to my upcoming Private Money Conference. It's the Private Money Conference. It's a $3,000 event, and because you're listening to my show, you get to come for a $97 registration fee. The Private Money Conference, you can check it out at www.jayconner.com/event. Next event's right around the corner. jayconner.com/event, and I look forward to seeing you in person. See you right here on the next Raising Private Money.
Are you feeling inspired by the knowledge you gained in this episode? Then head over to jayconner.com/moneyguide. That's jayconner.com/moneyguide and download your free guide that shares 7 reasons why private money will skyrocket your real estate investing business right now. Again, that's jayconner.com/moneyguide to get your free guide. We'll see you next time on Raising Private Money with Jay Conner.